Hey everyone, what's up? Welcome back to InvestStream Q&A. I'm Pankaj, and today we're going to be talking about accelerators right after this. Welcome back. So we had a viewer ask about the role of accelerators and how do they really help startups. Now, I've helped run two accelerator programs, one in India, one in Silicon Valley. I'm on the investment committee for an accelerator out in the Middle East, and I'm a mentor at an accelerator in New York City. Needless to say, I've spent a good amount of time around accelerators, and I've gotten a chance to see the value that they can provide to early stage startups. Now, most accelerator programs are modeled after YCombinator, the preeminent accelerator program started by Paul Graham in 2005. The idea of an accelerator is centered around providing entrepreneurs more than just real estate. They're designed to provide a curriculum-based approach to getting ideas off the ground. Now, when I say curriculum-based approach, what I'm referring to is if it's an idea stage accelerator program, they may spend week one honing the idea, figuring out how do you get to an MVP, minimum viable product, as quickly as possible. How do you get the product in front of your users or customers? And how do you determine whether users are going to be excited about using the product or customers are going to be excited about using the product and paying for it? By week 12, the program might be focused on honing your verbal pitch as well as fine-tuning your pitch deck that you're sending out to investors. And in between weeks 1 and 12, there's a whole host of other topics like design, metrics, everything else that's going to be covered, and you're going to be coached in implementing some of these things. In some other accelerator programs, the models might differ a little bit, but generally in curriculum-based cohorts, this is how most of the accelerator programs work. The best accelerators not only design the best curriculums, but they also bring in the best entrepreneurs, engineers, and investors from the ecosystem to be mentors. There are a lot of great accelerator programs out there. It isn't just YC or bust. Each accelerator program has something that it focuses on that makes it unique. And it could be anything from being vertically focused to being geographically focused. So, for example, if you are a fintech startup, perhaps it's a better idea for you to apply to a fintech accelerator rather than applying to a generic accelerator. If you are a startup that's based in upstate New York and traveling to Singapore is not optimal, perhaps applying to a geographically focused accelerator that's based in upstate New York makes a lot more sense. Regardless of their differences, most of these accelerator programs are modeled after YC. And what I mean is, generally there's an application process. So startups will apply, the accelerator will accept the applications, review the applications, filter the applications. Those applications that they think could potentially be a fit will be invited to interview with the accelerator. After the interview process, decision making is done, and those that are accepted into the program are offered a spot, and that usually begins the legal process, which in most cases includes an offer to invest in the company. Now, what this means is if you're applying to a accelerator like a YC is probably going to send you a safe agreement, which essentially allows YC to invest a certain amount of money into your company for a certain amount of equity. In order to invest a certain amount of money, YC needs to have money that they can invest. Well, because of the amount of competition, the amount of money that accelerators invest has steadily been increasing globally. And at the same time, a lot of capital has shifted towards the top investors, not just accelerators, but just investors. So a lot of new accelerator programs, which may be very good, just don't necessarily have the capital available to invest. So some of them are offering startups space and help in exchange for equity. They are not committing to investing in any of the companies. They might invest some point in the future. They may not. I'm not a fan of this model. I think it may work in less developed startup ecosystems, but it generally doesn't work in more competitive ecosystems like in New York or Silicon Valley or Beijing or Bangalore. I'm not a fan of this model because I believe it creates some signaling risk if the accelerator invests in some companies and not others. But more importantly, it doesn't provide any capital to a startup that needs capital, and it takes away equity. As an investor, if you're confident in your process and your ability to attract quality startups, write a check, right? The startups can use that money to do some initial testing, user testing. They can use it to hire a designer. They can use it for a whole host of other things. Maybe you're going to get a slightly better deal by investing a small amount of money at a lower valuation. In certain parts of the world, like India, accelerators have gotten a really bad rap over the last couple of years. A lot of founders won't even consider an accelerator as an option. Now, founders might be right, and in recent years, most accelerators in India have either shut down or completely changed their cohort and curriculum-based models to something else. However, one of the most renowned investors in the world recently announced that they're going to be starting an accelerator program in India for early stage companies, Sequoia's Surge program. Accelerators can play an incredibly important role in bringing mentors and resources to an early stage company that are invaluable. The founders can then tap those resources to help figure out scaling their technology, finding initial product market fit, determining pricing points for their product, figuring out tracking their KPIs better, etc., etc. Regardless of what differences are between these accelerator programs, you as a founder should be doing your due diligence on every investor, anyone who you are going to give equity to or take money from. Now, I did a video a few weeks ago, 4 tips on raising money for your tech or crypto project. I highly recommend taking a look at that because it is relevant when it comes to accelerators as well. The top accelerators in the world are going to be the hardest to get into, and they will add real value. Other accelerator programs can be just as good. If you do your research, you talk to founders that have gone through these programs in the past, you might find that they're actually better suited for you than some of the large ones. Of course, the value that you as an entrepreneur can get out of an accelerator program depends on you and how you use the resources provided by the accelerator program to both extract value, but at the same time contribute significant value back to the network. I hope this helps answer some of your questions about the role of an accelerator and how it can be beneficial to you as a startup. If you've been a part of an accelerator program, please share your experience in the comment section below. If you'd like to share the name of the program that you've joined, fantastic. If you've been part of a program that didn't really live up to your expectations and you don't want to share their name, that's perfectly fine too. Either way, share your experience because there's a lot of other entrepreneurs that can benefit greatly from that experience that you've had. And a lot of the accelerator programs can benefit from the feedback as well. So I urge you, please share your experience below. And I will see you on InvestStream Q&A next time. Thanks again for joining me. If you've got a question, feel free to drop us an email at investstream@blockhack.io or tweet me on Twitter, or feel free to leave a comment in the section below. Don't forget to hit the subscribe button so you don't miss a single episode of InvestStream.